You have probably heard people say they lost everything in the stock market. But here's the ironic part. Most of them never actually lost money because the market crashed. They lost money because they did not understand what they were buying. That's the real cost of ignorance in this game. Today, you are going to learn every stock market term you need to know, not the watered-down version. The actual version, the one that will let you sit in any room, read any financial headline, and know exactly what is happening with your money. So let's start with the thing everything else is built on. What exactly is a stock? When a company needs money to grow, it has a few choices. It can take out a loan, or it can sell pieces of itself to the public. When it sells those pieces, each piece is called a share, and the collection of all those shares is called stock. You buy a share of Apple. You now own a tiny fraction of Apple Inc. That's it. That's all a stock is. Fractional ownership of a real company. Common stock versus preferred stock. Now, not all shares are the same. Companies issue two main types. Common stock is what you and I buy. You get voting rights on major company decisions, and you can earn money when the stock price goes up. But if the company goes bankrupt, you are last in line to get paid. Preferred stock works differently. You give up your vote. In exchange, you get paid a fixed dividend first, before common stockholders get anything. Think of it like being a priority creditor who also happens to own a piece of the business. Most people talking about stocks on social media, they are talking about common stock, blue chip, growth, and value stocks. Within the world of common stock, you will hear three terms constantly: blue chip, growth, and value. Blue chip stocks are shares of massive, financially stable companies with a long history of solid performance. Think Johnson & Johnson, Coca-Cola, Microsoft. These are the ones that tend to hold their ground when markets get ugly. Growth stocks belong to companies expanding faster than everyone else. Amazon in 2012, Nvidia in 2022. These companies rarely pay dividends because they put every dollar back into the business. The trade-off? You are betting on future earnings, not current ones. Value stocks are companies the market seems to have forgotten or underpriced. A value investor looks at the financials, sees the stock trading below what the business is actually worth, and buys it. Warren Buffett built his entire fortune doing exactly that. Bonds, ETFs, and index funds. Stocks are not the only asset class you need to know. A bond is debt. When you buy a bond, you are lending money to a company or government. They promise to pay you interest over a set period and return your money at the end. Bonds are slower, safer. They exist to balance out the chaos of the stock market in your portfolio. An ETF, or exchange-traded fund, is a basket of stocks or other assets bundled together into one product you can buy on an exchange, just like a single stock. If you buy an S&P 500 ETF, you are buying a slice of 500 different companies in one transaction. An index fund works the same way, but is designed to exactly mirror the performance of a specific market index. The goal is not to beat the market, it's to be the market. When you evaluate either of these, you will see something called an expense ratio. That is the annual fee the fund charges you, expressed as a percentage of your investment. A 0.03% expense ratio means you pay $3 per year for every $10,000 invested. Keep it low. How the market actually works. Here's where most beginners get confused. They think the stock market is one single place. It's not. The stock market is a system of exchanges. The biggest in the world is the New York Stock Exchange. NASDAQ is the second biggest, known for listing technology companies. Every weekday, the NYSE opens at 9:30 a.m. Eastern Time and closes at 4 p.m. During those hours, buyers and sellers are constantly trading. To participate, you need a broker. That is the middleman who executes your trades. Today, most people use digital brokerage platforms. You open an account, deposit money, and buy shares. Platforms like Fidelity, Webull, and Moomoo are popular options. Before you ever risk real money, use paper trading. That is a simulated trading environment where you practice with fake money. Virtually every modern platform offers it. Use it. Lose fake money first before you lose real money. Bid, ask, spread, volume, and liquidity. Every time you look up a stock, you see two prices: the bid and the ask. The bid is the highest price a buyer is willing to pay right now. The ask is the lowest price a seller will accept. The difference between them is the spread. On popular stocks like Tesla, that spread might be 1 cent. On a tiny obscure stock, it could be 50 cents or more. Volume tells you how many shares traded hands during a given period. When a stock moves big on high volume, that move carries weight. It means real conviction behind the price change. Liquidity tells you how easily you can buy or sell a stock without moving the price. A stock trading 50 million shares a day, you can get in and out instantly. A stock trading 10,000 shares a day, your own buy order might push the price up before you finish filling it. Order types that every trader must know. When you go to buy a stock, you don't just click buy. You have to tell your broker exactly how you want that purchase handled. Get this wrong and you can lose serious money. A market order tells your broker to buy or sell immediately at whatever price the market is currently offering. It's fast, but in a volatile market, the price you see and the price you get can be very different. That gap is called slippage. A limit order says, I want to buy this stock, but only at this specific price or better. If the stock never hits your price, your order never executes. You stay safe, but might miss the move. A stop-loss order is your safety net. You set a price below your purchase price. If the stock falls to that level, your order automatically sells. It caps your downside. The risk? If a stock gaps down overnight, your stop triggers at the open price, which could be far below where you set it. A trailing stop moves with the stock. If your stock climbs from $100 to $150 and your trailing stop is set at 10% below the peak, it drags up behind the price. It locks in gains automatically. If the stock then drops 10% from its high, you are out with a profit. How to read a stock's fundamentals. Once you know how to buy, you need to know what to buy. That starts with fundamental analysis. You are looking at the actual numbers behind a business to decide if it's worth buying. Market cap tells you the total dollar value of a company. You calculate it by multiplying the current share price by the total shares outstanding. A $10 stock with 1 billion shares has a $10 billion market cap. The share price alone tells you nothing. Market cap tells you the size. Earnings per share, or EPS, is the company's profit divided by its number of shares. Rising EPS over time is the engine behind long-term stock price growth. The price-to-earnings ratio, or PE ratio, compares the stock price to its earnings. A PE of 30 means you are paying $30 for every $1 of earnings the company produces per year. A high PE says investors expect strong future growth. A low PE might mean the business is struggling, or it might mean the stock is underpriced. Context matters. The debt-to-equity ratio shows how much debt the company is carrying relative to what shareholders actually own. The lower this number, the better. Highly indebted companies get crushed when interest rates rise. Beta measures how volatile a stock is compared to the overall market. The S&P 500 has a beta of 1.0. A stock with a beta of 1.5 is 50% more volatile than the market. It will rise faster during rallies and fall harder during sell-offs. Reading the chart. Technical analysis is the second discipline. Instead of studying the business, you are studying the price chart. You are looking for patterns in how people have bought and sold in the past. Every candle on a candlestick chart shows you 4 numbers: the open, the high, the low, and the close. If the close is higher than the open, the candle is green. Lower than the open, it's red. The thin lines sticking out from the candle body are called wicks. They show you the extreme highs and lows of that trading session. Support is a price level where buyers consistently show up. Think of it as a floor. Resistance is the ceiling, a level where sellers keep appearing and stopping the stock from moving higher. When a stock breaks cleanly through resistance, that level often becomes the new floor. Moving averages smooth out the noise in daily price data. The 50-day simple moving average and the 200-day simple moving average are the two most watched. When the 50-day crosses above the 200-day, that's called a golden cross, a signal that bullish momentum is building. When it crosses below, that's a death cross, a warning that a longer-term downtrend may be forming. The VWAP, or volume-weighted average price, calculates the average price a stock traded at all day, weighted by how much volume happened at each price. Day traders use it as a real-time benchmark. Trading above VWAP is generally considered bullish for the session. Below, VWAP is bearish, short selling, and the GameStop moment. Here is where things get interesting. Most investors go long. They buy shares hoping the price goes up. But there is another strategy, short selling. Short selling means you borrow shares from your broker, sell them immediately at the current price, wait for the price to fall, buy them back at the lower price, return the borrowed shares, and keep the difference as profit. The risk is theoretically unlimited. If you short a stock at $20 and it climbs to $200, you are down 900%. There is no ceiling on how high a stock can go, which means there is no cap on how bad your loss can get. This asymmetric risk is what creates a short squeeze. Here's how it works. Hedge funds have heavily shorted a stock. Retail investors notice. They buy aggressively. The price climbs. Short sellers start panicking. To stop their losses, they are forced to buy back shares. That forced buying pushes the price even higher, which forces more short sellers to buy, which pushes the price higher still. It becomes a feedback loop. January 2021. GameStop. Hedge funds had shorted more than 140% of GameStop's publicly tradable shares. A community of retail traders on Reddit coordinated a mass buying campaign. The stock went from around $17 to an intraday high of $483. Institutional short sellers lost billions. The entire financial world had to reckon with the fact that organized retail investors could move markets. IPOs, stock splits, and buybacks. A company goes public through an initial public offering, or IPO. It issues shares to the public for the first time, raising capital and giving early investors an exit. IPOs generate a lot of hype, but the first day of trading is often driven by emotion, not fundamentals. A stock split happens when a company divides its existing shares into more shares at a lower price. Nvidia did a 10-for-1 split in 2024. Walmart did a 3-for-1 split in 2024. Your $100 share becomes 10 shares at $10 each. The company's total value does not change. It's cosmetic, but it makes the stock accessible to more retail investors. A buyback is when a company uses its cash to purchase its own shares from the open market. Fewer shares outstanding means each remaining share represents a larger slice of the company. EPS goes up. Buybacks are one of the most shareholder-friendly moves a profitable company can make. Dollar cost averaging and diversification. Here is a strategy that removes the hardest part of investing: timing. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. Every month, $200 goes in. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, your average cost per share smooths out. You stop obsessing over the perfect entry point because you stop needing one. Diversification is the strategy of spreading your money across different types of assets, so one bad bet does not wipe you out. Stocks and bonds, domestic and international, tech and healthcare. When one area falls, another may hold or rise. It doesn't eliminate risk. It distributes it. Warren Buffett's own advice for everyday investors: put 90% in a low-cost S&P 500 index fund and 10% in short-term U.S. government bonds. That's it. His argument is that this simple allocation beats the vast majority of actively managed funds over a 20-year period. 3 myths that will cost you money. Myth 1. You need a lot of money to start. You do not. Commission-free platforms and fractional shares let you buy a piece of any stock for as little as $1. The barrier is gone. Myth 2. A cheap stock is a safe stock. A $3 stock is not safer than a $300 stock. Price per share tells you nothing about risk. A $3 stock can go to zero just as fast as a $300 stock. What matters is the business behind it. Myth 3. You need to time the market. Research repeatedly shows that missing just 10 of the market's best trading days in a decade can cut your long-term returns in half. You cannot predict those 10 days. Neither can the professionals. Stay invested. You now know the language of the stock market. They are the tools you use to make rational decisions with your money instead of emotional ones. The market will always be there. The question is whether you show up prepared or not. If this video helped you, hit the like button. It helps more people find content like this. Subscribe so you don't miss the next one. and drop a comment telling me which term you want explained in more depth. I read every single one.